Okay, so good day, everyone, and welcome once again. Okay, very, very good to have you here on our class for today, where we're going to be looking at one of the very key aspects of trading, especially when it comes to SMC. And this particular aspect is quite misunderstood. That's when it comes to Wyckoff, right? A lot of people they've heard about it, right? They've heard about Wyckoff, they probably know some of the schematics, but they don't really understand how it can be used, right? And how best it can be used. So today we're going to be breaking down diving down deep into the Wyckoff. Basically, what exactly is Wyckoff schematic? What it's all about? We'll look a little bit at the background of where it came from, which is Richard Wyckoff, and then I'll show you how it happens everywhere, in every market, in every time frame. The Wyckoff is something I like to regard as a snowflake effect. And then I'm going to link this a little bit with what we already know with regards to trading. Okay. So to begin, I'm going to discuss a little bit about the market, right? With regards to how the market moves and what we tend to look for, right? Now, we all know that as traders, basically, we're looking for opportunities to buy, to get into the market, where we get involved in the market and the market begins to move, going upward our way. And then when we're looking to sell, we want to see the price go down, right? Now, the market is not always trending one way or the other. Sometimes the market is in what you call a range-bound market, right? Now, at those times, what you don't know what happens is the market is actually undergoing some sort of accumulation or distribution schematics, right? Now, this particular schematic is what Richard Wyckoff studied. He actually made his discovery in the stock market, and he saw some of the blueprints of the composite man. So he refers to them as the composite man. We'll take a little bit a look at that in a bit now. And you see his explanation of how the market moves, the phases in the market, and how you can look to take advantage of them. Okay, so quickly, let's go up to the next slide. Okay. Okay, a very brief intro about me. My name is Nana Alexander. I am the head market analyst and senior educator here at ANZO Capita. I am, called the FX JEDI, so you could look me up. Now, here's what we'll be looking at quickly today with regards to Wyckoff. So we'll look at what exactly is the Wyckoff theory, what is it all about, right? We'll also consider his 5-step approach to the market. Now, what you need to know is he applied this concept to the stock market, to the stock trading. But this same concept is applicable now, just the same way Fibonacci. You remember the Italian mathematician Fibonacci that discovered Fibonacci sequence, and then we decided to apply it to the Forex market, and it works. The concept or the schematics that he discovered in looking at the stock market, how the market went from phases to phases, and what happened within those phases, can be very, very powerful for you. I'm going to break that down in a way that you probably never really had it broken down for you. Okay, and then we'll look at in detail what he referred to as the composite man, right? So Wyckoff tagged the power that let me call them that the composite man, and then we'll look at those price cycles, and then we'll look at some live prices. I'll show you a particular trade that I took last week, right, on the market, and actually this week with regards to this exact schematic and how you can find them everywhere. I'll also show you, and also at the end of the class, I'll also discuss how you can't necessarily just read Wyckoff, right? Wyckoff in itself is quite powerful, but it has to be applied to market structure, right? Now, here's one thing we know about the market, right? That the market doesn't go up in a straight line, right? When the market is bullish, when the market is going up, which we call bullish, the market tends to do so in waves, right? It makes higher highs and higher lows. Now, those of you online, I hope I'm using the whiteboard here. I hope you can see what I'm doing. Now, the market tends to move in waves where it doesn't just move up in a straight line, right? It goes up, it pulls back, it goes up, it pulls back. Now, so we can identify a bullish market, right, by a market that consistently is making higher highs and higher lows. Now, it's not always going to be that clear. Sometimes the bullish market might make a lower low, which is what I tend to call the accommodation, and then continue pushing higher. It's perfectly okay. But the idea is by looking at the overall order in the markets, right? When trading, you want to approach trading from a what I like to call MTFA, that's multi-time frame approach. So you want to, just even though you look to get involved in the market in a specific time frame, you want to balance both the higher time frames and the lower time frames. So personally, I get involved. My entries are usually based on the 5 minutes or the 15 minutes charts. But I look at the markets based on the overall structure, even as high as the monthly charts. So I try to get the overall structure of the market, right? And then try to get involved. So again, a good example of what I like to see in the market. Let's say I look at a chart and I'm looking at the overall market, and let's say the weekly chart is bullish, right? So it's making higher highs and higher lows. So let's say this is the weekly chart. Now, this portion of let me see. Those of you online, can you see the whiteboard? Okay. No, okay. Let me see if I can spotlight this. Okay, this might be difficult for you to see, but I hope it should be better now. Okay, now, so basically, let's assume that I'm looking at the weekly time frame and the market is basically doing something like this. So it's bullish, it's making higher lows and higher highs, right? Now, let's say current price is currently here. So this section here is current price, right? Now, within this area here, now if you look at this move here, this down move here, which is the weekly chart, on a 4-hour chart, it could look something like this. It could look very bearish. You know what I mean, right? So this move here on a 4-hour chart will look like this. So if you're looking specifically at the 4-hour chart, it will look like you're in a very, very bearish market, right? So if you don't understand the context, right? Context in the market is very important. If you don't understand the context of where you are, and you're just trying to get involved based on, oh, this is my entry, but this is the time frame I trade, and then you just only look for entries within that area without taking into consideration the overall structure of the market, you actually find it quite difficult. Now, in the 4-hour, let's say in the 4-hour or the 1-hour or even the daily chart, you could have something like this. Now, what I want to see would be for the markets to then begin to break bullish. Now, what you notice is on the 4-hour chart, right? This 4-hour chart now, it has broken bullish. On the weekly chart, it's still be very bearish. Does not change, right? Now, this bullish break on the 4-hour chart is now lining up with this overall structure, the overall bias that I have with regards to the weekly time frame, right? Now, on the 15-minute time frame, the market will still look very different. But looking at the same chart, on different time frames, it will appear very, very different. So what I like to see is a confluence, right? Now, what you will find most times is at these areas, right? These areas where it appears like the market was going down, and then all of a sudden the market stopped, started going up, right? At those specific areas, what you usually find are Wyckoff schematics. Right? Same thing applies here. This area where it appears that the market was going up and then all of a sudden it stops and then begins to come down, right? What you find at those areas are distribution schematics. So there are two types of Wyckoff schematics. So there's the accumulation schematic and then there's the distribution schematic. Okay, so we'll go down, we'll go a lot into them and break them down, right? I'll show you what the schematics tend to look like. But the simplest way, in terms of Wyckoff, what I want you to think about when it comes to Wyckoff is that what is happening is basically weak to strong hand transfer, right? The market is undergoing weak to strong hand transfer. Okay, so okay, so very, very basic description to So let's just do a very quick rundown with regards to what Wyckoff, Richard Wyckoff made mention with regards to his theorem, right? Now, so this is just, you can find this from stock. I think I could even post the link to the website here, right? So basically, he was a trader, right, and an investor, somebody who looks to take advantage of the forex market. And in the early 1900s, late 1800s, he discovered an idea where it seems like when the market is ready to begin to change shape, there is something that always tends to happen, right? And then he documented his findings. And it's that documentation, that documentation of those schematics that we now study and look to them and try to make sense of them. Okay, so he was also in line with he lived during the time of Elliot, Dow, and Jones. So these are some of the theorems. Someone says we can't see. Okay, so people online, you find it a little bit challenging. So let me. Okay, those of you online, you can see my screen, right? Just quickly, just let me know you can see my screen so I can push ahead. Okay. Okay, that's good. That's good. Okay, so basically, right, what he observed that many times. Now, what I need you to understand when it comes to trading in forex markets is that it doesn't matter whether you're trading with $100,000 or $1 million. Your money doesn't really matter, because the money in the market is so huge that you swallow that money in the blink of an eye, right? So you don't want to approach the market as though you are the power that, right? Why? He understood that he called them the composite man. Now, it's not necessarily one person. It could be a group of organizations, but where the majority of the power in the market is. And you know, when we talk about the forex market, we make mention of the fact that it is a $7 trillion daily market, right? Okay. Sorry, just quickly. Okay, we're back now. Okay, good. Okay, so now, like I was mentioning, in the markets, we usually tend to say that the market is, a $7 trillion daily market. So every single day in the market, $7 trillion is exchanging hands, right? Now, the majority of that money is what I like to call the composite man, right? The big banks. My funds and your funds are the smaller part of it. So we only make up about 10% of the money in the market. Now, basically, you know that where there is the power is with the man with the most money, right? Yes. So we on our own cannot move the markets, right? The best opportunity we have in making money is try and follow the guy. They say follow who no road. Right? So because if you try and pump, you try and double down on the lots, 100 lots, the market to swallow it in a blink. But if you're trading in the direction of the money, then you find it much easier. And that's exactly what the whole Wyckoff concept is about, right? So it's like about trying to figure out what the composite man is trying to do, right? By looking at the footprint of what is leaving behind. Now, when it comes to trading, there's sometimes you need to understand about the markets. The composite man is always buying and selling. So he doesn't just buy at this point and then take price up and sell at this point and then take price down. At every single point in the market, he's always getting involved in buys and sells. However, depending on what direction they really actually want to push price, there is more, maybe if you want to make price go up, there'll probably be more buy orders than there is sell orders. And then you see that resultantly the market will go up. This is what, this whole concept is what leads to what we see as imbalance in the markets. That sometimes you see that the market gap up very much, right? Only to come back down, mitigate some of those orders, and then continue going up, right? Now, a good understanding of mitigation is It's very important when especially when we're discussing this, when we start getting some of the explanation of the Wyckoff. But it's actually quite interesting and straightforward once you get it. Okay. So so basically, this is his 5-step approach, right? So Richard Wyckoff, this is the 5-step approach that he looks to when approaching any particular market. So he uses these concepts in trading stock, right? But we apply the same concepts to the market because the market moves in tandem. The market moves the same way. So the first thing is you want to determine the present position and probable future trend in the market. So you want to determine the overall structure of the market. Is the market bullish or is it bearish? And you know that simply by just zooming out or looking at the higher time frame. You know, you can look at the 1-minute chart, right? And it looks like this, like wow, this thing is going down. And you switch up to a 4-hour chart. Yes. Yes.
So you know, we just came now. I want to take you back.
Okay.
Are you on stock or FX?
FX.
FX.
Yes.
Okay, what topic are we treating?
Wyckoff. Wyckoff. Yes.
Wyckoff is
it's
a strategy.
Yeah, it's
one of the approach.
Yeah, it's one of the strategies. Strategy. Yeah.
In trading Forex,
yes,
right?
Yeah.
Okay, thank you. I just wanted to know.
Okay.
Thank you.
No problem. Okay, so let's say you're looking at the 1-minute chart. If you look at this and you're like, oh, this market is very bearish, right? And then you look at the 4-hour charts and the market is doing this, right? So just looking at one time frame doesn't tell the whole story of the market. Now, but here's the thing, irrespective of the time frame you're looking at, you would see the same thing in the market. Because the market is like a snowflake. That means, if you pick a snowflake, if you break it down, it's still made up of multiple snowflakes. It's still the same thing, even if you keep breaking it down. It's like atom, right? So even a 1-minute chart, if I remove the time frame, it will still look, when it's going up, it will make higher highs and higher lows. And when it's coming down, it will make lower lows and lower highs. If I remove the time frame from the chart, you'll not be able to tell me what time frame it is. However, the lower time frame is controlled by the higher time frame because that's basically what determines the overall trend. So the first point is you want to figure out where are we in the market and what is the probable. Remember, as traders, we are speculative traders. We don't know for certain where price is going to go. We are trying to figure out where price will go and then stake some part of our money, right? So there are several strategies to doing that. And many of them, you can't make profit with all of them. But the main thing with regards to any strategy you choose to trade is you have to be consistent because no strategy will make you money all the time, right? And no strategy will lose you money all the time. So you need to figure out, okay, what is the expected value in terms of risk to reward ratio, in terms of win rates, and then figure out, okay, I like this and I want to stick with it. So we're going to look at understanding. So basically, when it comes to Wyckoff, this is a kind of like a confirmation, right? We use Wyckoff as confirmation. So let's say, in terms of other examples of confirmation, it could be like something like candlestick patterns, right? So we all have heard of candlestick patterns. So you say, oh, you look at a bullish pin bar or a bearish pin bar, and if you see that, you look to buy or sell. Now you don't just buy or sell every bullish or bearish pin bar, do you? No. If you do that, you make a lot of losses. You want to buy a bullish pin bar if it appears at an area that makes sense for you. So let's say, for instance, at the level of support. Let's say price is bullish. Right now, I'm digressing a little bit here, right? Now, let's say you're looking at the market that is bullish, right? You've drawn your level like this. Now, if a bullish pin bar appears here, doesn't really make much sense to buy it. Because it appears everywhere, just like the snowflake rule. It appears everywhere. However, if a bullish pin bar appears at, let's say, a level of support that you're interested in, then it probably makes more sense to maybe buy this. I don't know if you get that. So in the same way, you would see Wyckoff schematics everywhere in the markets. However, we're supposed to use it as confirmation to go in direction of the trend that we already. So we should have a predetermined bias. You don't just come to the market and, oh, there's a Wyckoff accumulation occurring, let's buy. Or there's a distribution schematic occurring, let's sell, right? So what we'll do now is we'll look at some of those schematics because I've been mentioning them, okay? And You can't see the screen, people online. You should be able to see my screen now. So we have more people online than we have here, actually. Okay, I hope you should be able to see my screen now. Okay, so now I'm going to explain the composite man a little bit. I know I've talked about it in a bit, but the way Richard Wyckoff pictured it, what he noticed is that it's as though there is somebody that is moving the markets. Now, there's no one person that's moving the markets, right? But what happens is those big banks, the big players in the markets, when they move the market, they tend to move in tandem, because guess what? They can see the order flow. They can see where the majority of orders are lying, and basically they try to grab with it. Okay. So what he realized is that all fluctuations in the markets, whether it's stock, any assets, whether it's cryptos or FX or stock, all fluctuations in the market are, you can approach it as though they were the result of one man. So think about it then. Remember, the Forex market is a zero-sum game. It's a zero-sum game. You're winning because somebody else is on the wrong side of the market, right? So what you want to do is to position yourself on the right side of the market. Now, imagine there's one man that has out of the 7 trillion, there's one man that owns 6.9 trillion. And then the rest of us are only trading the remaining 10, let's call it 10 billion, right? Now, what do you think that one man will be going after? What do you think he'll be going after? Our money. Yes. Do you understand? Yes. If you're going after our money. Now, what you would like to do most of the time is to move the market such that we believe price wants to do something, whereas price wants to do the opposite. How many times have you opened a trade because you see a big bullish candle only for the market to just sell off? And you're wondering, what? Why? Like, see price, the market just stop only to come down and continue going down. Or it goes down only to, and everybody's excited, okay, let us start selling, and then it goes up and continue going up. Now, I need to think about it this way, right? When price moves most traders are emotional beings, so they have an idea, right? So let me just use this line.
Sorry, sir.
Yes.
But in this analysis, you can't do analysis is not always correct. It's volatile. You cannot determine if you see a candle that you notice that it's going to pump up, all of a sudden it starts coming down. So you're telling us that we should not depend on that region, that it's not settled.
Yeah, the point is you can't depend on just one thing, and even no matter how good you are, you still make losses. You have to be reserved to that fact, right? It's one of the things that always baffles me about traders not trading with stop loss, as though you know where the market is going. Because so personally, the way I look at approach trading is I have an idea behind what I want to see price do. So I open the chart, I look at the chart, and I'm like, okay, I want to see price go up. So let me show you something quickly. Okay. So let me use, I think this would be, oh, okay, you guys cannot see it here. Yeah, so I'll just have to disconnect this. Okay. Now everybody should be able to see this part quite clearly. Okay, now, so here's the thing, when I approach the markets, I already have an idea behind what I want to see occur. Now, whether it occur or doesn't occur is another different case entirely, right? But I already have a bias I want to trade. So, for instance, now in Euro USD, at where price is now, I want to see price go up. That's my analysis. But I'm not buying. Notice, I want to see price go up, but I'm not buying. I want to confirm that price. I want to see that price is now going up before I actually get involved buying. Now, price might even give me that confirmation that it wants to go up, and I start buying and it fails, it's okay. I know that that will happen. Do you understand? And I'm not going to now try and jump in just again immediately because of sentiment. So when trading, you want to approach it in such a way that, well, you have a bias, an idea as to what you want to trade, and then you have what you're looking for to confirm that bias. And then once everything aligns, you now say, okay, I want to risk 1% on this trade. Now, if you make, let's say, if you're correct, maybe your 1% because of your risk to reward ratio, maybe ends up giving you 5 or 6%. Good business.
Okay, at this chart now,
yeah,
if you meet up a trade, Euro USD at this chart,
yeah,
where can you start? Where will you be comfortable to buy?
It's not where, it's what I see in the market.
That's what I'm saying. This is what you are seeing in the market.
No. Right now,
the fluctuations of the candle.
Yeah.
You understand?
Yeah.
Even to the extreme. So at what point will I buy as a new person coming into the system?
Okay, so first of all, as a new person coming into the system, you don't buy.
I shouldn't buy.
Don't buy. Just learn. Okay. Now here's the thing, here's the thing. What I've not even gotten to the Wyckoff part, but I'll show you some things here, right? Now, notice, like I did mention earlier, right? The market tends to move like this. Now, at those areas, this is, we'll call this the bullish market.
Yes.
At this area where it appears, there was heavy selling. And all of a sudden, the price began to go up. And then there was, heavy buying, price stopped and started to go down. Right? There was selling, like market was selling, stopped and started to go up. You see that here as well. You see that price was going up, right? Aggressively and stopped. Pulled back, stopped, went up, stopped. Now, what do you notice? What you will notice, either in this time frame that we're looking at it from, or sometimes when you go down into smaller time frame, is that the market it would create some sort of stopping action. Like, notice the price was just going down and then it halted, right? Before going up. And then it halted before coming down. I don't know if you're seeing what I'm showing, right? Same thing here, halted before going up and then it's down. So what I want to see here now is probably another halt and then continue to go up. Now, it's these stopping actions, these areas where price appear to have stopped. That's where we are looking for our Wyckoff. Do you understand? Yes. Those of you online, I hope you are following. I think, okay, let me turn this on. So.
Price stop. That's where you make decision either to buy or wait.
Yeah, it's based on this particular system. There are several systems. Okay, so now, let's see. So let me go back to schematic, because I want us to just quickly look at the schematics and then we would okay, so this is, I think I'll leave it like this. Okay, so this is the price cycle that Wyckoff described, right? So basically there is the accumulation, right? There's the actual markup, there's the distribution, and then there's the markdown. Now, there are 3 cycles here. Imagine the composite man wants to push price from point A to point B. So let's say this is point A, right? He wants to push price from a point A to point B. He wouldn't just I can't say. Didn't go there saying. Okay. So let me just. Okay. So basically, like what was making mention of earlier, is the market is really going from one region to another. Now, what you refer to as oversold. Now, some, let's say, RSI indicators and all of those things might say, oh, the market is oversold, overbought. I don't necessarily use indicators or those indicators. But what usually happens, or what we're usually looking for, is some sort of accumulation schematic. Now, think, like I was trying to say, imagine that the composite man wants to push price up, right? Now, remember, if he buys against himself, he doesn't make money. I don't know if you so think about it this way, right? If, for instance, you have iPhones, right? You have iPhones, lots of it, a container full of iPhone 14 or iPhone 15, whatever, right? And you want to sell those iPhones for, let's just say 500K. You want to sell them for 500,000. You have money to buy the phones. Now you put what you want to do is you want to put the phone on the market and hope for people to buy them, right? But if nobody buys them and you remove money from your pocket and buy them, does it make any sense? It doesn't make sense. The only way you make money is when other people are buying what you're selling. Do you understand? So in the same way, in the market, there are only two things that can happen. The markets can either go up or go down, and we can either buy or sell. So the composite man, when he wants to make price go up or go down, he needs people. So let's say he wants to push price, he wants to take price up. He needs to make sure that he needs to get other people who are willing to sell so that he can buy from them. I don't know if you get my point. Because the only way you sell is the only way you buy is if somebody is willing to sell. If there's no seller, then you can't buy anything. So you will need to try and, move the market in such a way that it induces sellers, so that sellers will come in. And then when sellers come in, they can now gather their sales or their sales, buy it from them, and then push price up. So that he's buying at a low price to then take price up. So in doing so, what Wyckoff discovered is that there's usually some sort of schematics that occur, right? Which I'll show you in a bit, and then we'll look at them in the charts. Now, we'll look at some of these schematics. So there are two different schematics. One of them is the accumulation schematic, and the other one is the distribution schematics, right? So there's the accumulation schematic, which is what we look for. The accumulation schematic is a schematic that occurs just before price goes up, right? And the distribution schematic occurs just before price comes down, right? Now you see what this is a blueprint. This is not exactly what it's doing. It's not going to look exactly like this every single time, right? However, it will look something like this. What he discovered from studying price and looking at price is that, first of all, in phase A, this market, so this is an accumulation schematic. That means we want to see price go up, right? That means price must already have been coming down, right? So this market is bearish, price is coming down. And then what will happen is you will see some sort of stopping action, which is what he referred to as PS. So PS stands for preliminary supply, right? Preliminary support. So it's more like, oh, let me draw this here, right? So price is coming down, right? And then what you want to see is some sort of stopping action, right? And then, now you wouldn't know what this is at the time. When it's forming, you will not even know what it looks like. It's until then you probably start to see the schematics maybe at this point. Now, but what you notice is this market was trending, now it's ranging, right? So the market was trending, right? And now the market is ranging. So this PS, what you see here as PS, stands for preliminary support, right? And then after the preliminary support, what it means is, oh, this is the stopping action. We are slowing down our sales. And then what will happen is the market will make what we call a selling climax. So SC stands for selling climax. Now, this selling climax is one of the most important areas because when it happens, what we want to see is some sort of buying, an aggressive buying, right? But this buying should not exceed this preliminary support. So the There's no real way to do that. That's the disadvantage of online. Don't worry. Okay. Okay, so basically, so the PS, which is the preliminary support, is basically the halting of the selling action, right? And then we want to see the FC, that's the selling climax. Now, this selling climax, what you see is some sort of knee-jerk reaction. The market would push up. Now, I'll show you a live market, something like I made mention, something I traded on gold. I think it was this week or last week, right? Now, the price stopped, right? And then you see AR stands for automatic rally. Now, the AR should not exceed the PS. That means it should not go above here like this. If not, it's a different thing entirely, right? So the AR should be somewhere below this whole action here. Now, once that happens, what you'll see is the market will just stay a little bit here before start going up. This is what people will refer to as a ranging market. Oh, the market is trending, now the market is ranging. So when you see a ranging market, just imagine that the composite man is engineering liquidity, right? So that they can accumulate as much orders that they need to then push price in the direction that they want to go. Now, think about it from a trading perspective. When you see price ranging like this, what do you think it does? It's introducing buyers and sellers, not so. So, for example, when market was trending down like this, most people are looking for sells. But when the market begins to range, you see that, oh, some people are trying to buy here. Some people are trying to sell here. Some people, you know, they're always, but there are buyers and sellers in between. And here's what you need to know is that the composite man is not just buying, he's also buying and selling. Because most of those, when you see a candle, so you see a candle that just push, every single candle that moves with impulse, there is a lot of, there's a lot of buying. So you might see this might be a 1 hour candle, right? This might be a 1 hour candle. A 1 hour candle might look like this. But if you look at the 1 minute chart for this 1 hour candle, it might look like this. I don't know if you get my point. Yeah. So that means there were a lot of buying into selling, into buying, into selling, into buying, into selling. So the composite man was selling heavily and then buying back heavily. Simply just engineering liquidity, getting people involved. So what you want to do is get you involved to sell here. Then take you out, take your stop loss. Yes. Get you involved to buy here, take out your stop loss. Get you involved to sell here, take out your stop loss. So just engineer those liquidity both sides. And then using your stop losses or your buy stops or your sell stops to gather as much liquidity as possible. Then usually you'll see something like this, a spring. The market will appear to begin to go up, comes back down, clear the liquidity, and then begin to actually push. So this whole schema, something now it's not going to look exactly, like this. It's not going to look exactly like this every single time, right? But you'll be able to see each of these different phases within the market. Now let's look at a very quick example on the charts, okay? So let's look at gold. Yeah. Now remember, just like I said, the market, the snowflake effect is across board. So you will find schematics within different time frames, right? You find it within 1 minute time frame, within the monthly charts, within the weekly charts. Okay. Now the particular one I want to use as an example is here. Okay, I'm just going to use a fresh chart because this one has too many. Is this a fresh chart? I think it's the same one. Okay, I think this is it. Okay, so now just looking at this chart, right? So let me go up to the 1 hour chart here. Okay, just looking at this section, I'm not going to go and break down this particular trade from the weekly time frame and all of those. Those classes are reserved for market outlook classes and all. But just looking at this market, you see that the market is bullish, right? Just focus on this particular section of the charts that we're looking at, right? Price is bullish, right? Making higher highs and higher lows, and that's how we know it's bullish. Now, okay. So we'll look at this, we'll say, okay, this is the low that caused this high. So obviously there's a low. So low to high, to higher low to higher high, higher low, higher high, higher low, higher high. So basically we're making progressively, you're seeing that the impulse going up. So this is what I want to see in the market. When I'm looking to buy, I want to see that the direction that I'm looking to trade, the impulse is much. See when the market is coming down, it's not really, yeah. But when it wants to go up, it just shoots up, right? And then the same thing, it dangles, and then when it wants to go up, it just shoots up, right? So already I was looking at this market, I was a buyer in the market. I was only interested in buying opportunities, right? So now at this point, right? Now here's one thing, here's a free tip, right? When I'm looking at the markets, now let's say I am interested in buying, right? I'm always interested in buying based on structure. So let's say price is making from low to high to lower high, right? Or to higher low to higher high. Now, already I'm looking to buy. So let's say price comes down here and I find confirmation to buy, let's say Wyckoff, for instance. Where do you think I'm targeting?
High.
It's high. Do you understand? Yes. Now there's possibility to go higher, but this is the liquidity target. Because if anything, if the market wants to continue in this movement, then at least it should come to this high. So this should be where my area, this is the area I'm targeting. So when it makes a new high and then it pulls back, I'll start targeting this high. So in the same way here, right? In the same way here, at this particular point here, so let me use this. Okay, let me use this instead. So I'll just highlight the structure. So price is making, I don't know. So at the time I was looking at this particular market, so this was where price was, right? So this last dot that I drew here, here, this was exactly where price was, So let me just move this, right? Now look at this, this last white dots, for those of you online, the last white dots there. At the time I was looking at this particular market, right? See what, this is where price was, here. Price was here, around here, okay? Now, I was interested in buying as price began to come down. Where do you think my target was? Back up here, okay? And so as same thing, I took some trade here, although they were not based on Wyckoff. I took a very beautiful trade here. It was based on a different concept. But the reason I'm using this specific one is because it was based on Wyckoff. Okay. So at the time when price was down here, right? When price was now down here, I was waiting for confirmation to buy. Notice that I did not instantly start buying or start selling. Now, this is the 1 hour chart, right? Usually, when you're looking at the particular markets, right? The turnaround, so if it's the weekly chart, the turnaround will look very sharp. But on a, let's say 4 hour chart, this particular area will look something like this. Like it will look much more, you see the range within there. So now if we drop down to a 15-minute time frame here, right, and go back to that same area, which was here, okay? So at this point, now I'm going to label this so we can see. Now at this point, remember, I already have an idea of what I was trying to do. I'm trying to buy. This high here is the high I'm targeting, okay? And then price is pulling back down. All I'm watching for is confirmation to buy. Now notice what price begins to do. It began to slow down, right? Now what do you think it's doing? There were a lot of people who were trying to, they were trying to buy early. Yeah. Video traders, they're jumping in early. They're induced. They try to buy. Where do you think their stop loss will be? Down here, low price. It comes down, clear them out. So this would be, so in this particular instance now, this would be our preliminary support, right? Where the market began to stop. This would be our selling climax, right? And then after the selling climax, you see how price aggressively push up, right? So this would be our automatic rally. Now, after the automatic rally, we want to see the ST, that's the secondary test, as you can see here, right? Now, this secondary test could be lower, could be equal, or higher than the selling climax. Now, but what I want you to think about is what it is doing to the minds of traders. It's not exactly what it looks like on the picture, right? But what it's doing in the minds of traders. So traders at this point are like, it seems the market is now, so there's a bullish pin bar, right? The price is following through, and people are trying to get involved in the buys. What do you think they do? Or they'll try to do now? They'll either try and start buying, or they'll wait. Now, price comes down here, forms what you call a double bottom. You know those patterns. They'll say are double bottom patterns. It made some sort of an equal low. People are like, okay, now price really wants to get up, start going. And they start buying. What do you think price does? It flushes them out. Right? Now, most of these buys and sells that you're seeing here, which is being engineered by the smart money, right? What they call them smart money or composite man. They are selling heavily to then buy heavily, to sell heavily. So they are inducing traders to get involved. Now, at this point, when people see this, they're like, it's going up. They start buying heavily, and price pulls back down, clears the last liquidity, and then begins to go up. So all of this phase here, all of this stopping action here, right? All of this ranging market that you see here is what Wyckoff notices when he was studying this chart. That usually before, just prior to the stopping of a trend, there is some sort of distribution accumulation schematic that is undergoing. Now, it is not, this is the reason why, okay, yeah, you can even see it. This is the reason why we want to wait for the schematics to be completed and then get involved, because this schematic could easily become a distribution. So it's until this, if I go back to, let me go back to here, you'd see that in the phase D, so on the phase D, you can see the sign of strength, right? The sign of strength, or SOS, is what shows this sign of strength should basically be above this AR. It should clear the AR, maybe clear the preliminary supply support most of the time. So once we've seen the sign of strength, it's at this point here, that we want to begin to look for entry. So we're not trying to buy or do anything here, because most likely you get whipped out. We want to get involved when we've seen the money come into the market, not before. I don't know if that makes sense. We want to wait for the money to come into the market and then look to get involved, not before it came into the market. So in this particular instance here, it will be, you can see clearly, okay, let me zoom in a little. You see that the market was just stalling, solid, going up, going down, going up. This is where the money came involved. You can see that this cleared all the highs, right? Now, it came back down, right? It came back down to mitigate these positions. Now, remember that, like I said, the composite man is always buying and selling at the same time. So he sold in heavily here. Imagine selling 10,000 lots to push price down, and then buying 20,000 lots to take price up. As price is going up, those 10,000 lots are in a bit of a drawdown. So they'll come back to close out at least some portion of those trades to then begin to go up. So what we want to see after the sign of strength is for price to begin to hold structure. I don't know if that makes sense. So I want to see price to begin to hold structure, right, at these areas, and then we begin to get. I actually got involved on this trade at this candle here.
Yes.
Because as price came down, what I wanted to see, I didn't want to see price close below this low. If I draw a line here, you'll see it. This low here. Yeah, so there, right? Now, in this particular instance, price went below it, but you can see that it aggressively bought it back up. I was not buying here. Now, usually if I bought here, I probably have taken a loss here. I wanted to see the money coming. And then when the price came below this area here, so this is the area I'm talking about here, and then moved back up, you can see that this is from this whole move is coming from this push up here, right? It came back down, and then we're looking for this move back here, right? So this is where I got involved. As the price made this move, I got involved at the open of this candle and just, took this one to that high. You see, in this particular instance, price came to the high and then flushed back out. Now, usually, so in the same instance, if you go in here now, and let's say this is the 15-minute chart, or let's say the 5-minute chart, you'll see another distribution schematic. Yeah, so the whole idea with regards to this particular system of trading is you want to look for this structure in the market at areas you are interested in buying or selling. Note that I was already interested in buying this market based on the overall structure. And so as price is pulling back down, actually there was a previous imbalance here. That's what I like to call SND. There is a previous imbalance here. And I wanted to see price react from there. I wanted to see price begin to go up from there. And that is why when we got a schematic, an accumulation schematic here, I was willing to risk money on this one. Do you understand? Now, don't worry. I know it might be quite a lot at first, right? But it's something that you'll be able to get, right? I actually have on our ANZO training hub, there's an online course, right, which you can just take at your own time. One of the explanation there was on Wyckoff, right? So you see how I broke it down. We look at several examples. Okay. Now I'll look at another example so that maybe it can begin to make sense. Those of you online, questions. I hope you guys are following. I know it's not exactly easy because I'm using the board and I'm annotating with my hand. Okay, so let's. Okay, yeah, I think I labeled this one. So there's a. So now this is AUD-NZD, right? This is the daily chart. Now remember I showed you that one on a 1-hour chart, and then the Wyckoff was on a weekly chart, on a 15-minute chart. Okay, so notice, right? Now you see the resultant in this price is going up. I don't know if you don't. This is the daily chart, but by zooming out, you can see the order flow. Price is essentially making higher highs and higher lows. You can see it from here. This is from low to high to low to high. I was expecting low to new high. Right? Now, look at this particular area, right? Now, you can see that I have this particular gray, so this gray box, right? I had it highlighted. I was looking for, as price was making all this move, remember this is a daily chart, so this is a lot of move. As price was pulling back down, right? As price got here, I was interested in seeing confirmation to buy. So you understand how multi-time frame analysis comes into play. There's a context behind everything. Even though you can see the market is bullish, you would say this is the daily chart. So at the time, everybody's thinking, oh, this market is very, very bearish. But because I have a clear context as to what I'm looking for, I know that we are in a bullish market overall. And we are approaching an area that I'm interested in buying from. You can see there's Wyckoff here, but I wasn't looking at them. You know, if I go into a smaller time, I'll probably see some Wyckoff accumulation here, right? But because I was interested in this area, I was now waiting for confirmation to buy from that area. Now, if we drop down to the 4-hour charts here, I think the Wyckoff was clearer on a 4 or 1 hour chart. Okay, I think we can see it here. Now, remember, the market has been bearish, right? Market is bearish in that coming down into this zone. See what happened here. The market halted our preliminary supports, right? And then it pushed back down, made our selling climbers, right? Pushed back up, made automatic. Now, at this area, so this green box here, notice what price did. Before here, let me zoom out. See how price was just going down straight. It was just going down straight. And then as price got here, it began to range. Now, what is actually happening here is it is accumulating orders. And the only way you can do that is by getting sellers to get involved, taking them out, getting buyers to get involved, taking them out. Because remember, if you're buying, your stop loss is a sell. If you're selling, your stop loss is a buy. So we had, price, made a selling climbers, made an automatic rally, made several STs, right? So look at this candle, look at this big candle, right? What do you think would happen when, let me just move this here. Let me move this like this. Let's zoom in a little. Now, what do you think most people will be doing when they see this? When they see this big bullish candle? People are buying heavily. Oh, you can see, they've induced. Who do you think made this candle like this? It came down. So what happened is people were buying, right? This candle came down, cleared their stop loss, went back, made a very big bullish candle, right? Now, at this particular point, a lot of people are getting involved trying to buy heavily. Gold did the same thing yesterday, I think, right? And then what happened is price came down, cleared it. Again, so what you're seeing here now is basically the composite man liquidating positions and grabbing orders, right? So this will be our ST, our secondary testing phase B, right? And then price began to shift structure. So even people who are looking at structure to trade, you see that at this point, the market now started making higher high, higher low, higher high, right? People are expecting for it to make a higher low and then continue to make a higher high. Now, it could very well do that, and that would be a very good trade. But if I want to trade that, I probably want to see, so if this is the 4-hour chart, I want to see maybe like a 30 minutes or a 15-minute Wyckoff accumulation structure here to confirm this. So you see how I have an area, I'm looking for Wyckoff as confirmation on a specific time frame. Now, when I get to that area and I see something that I like, I want to go down and see even more Wyckoffs to get involved. And then what happens is, well, notice that, look at where our AR is, our automatic rally. This was where price came down, made a spring, and this is the first time we cleared that area. So it's at this point that I want to become a buyer. Because once the truth is, once the composite man is done accumulating enough orders, the way price would move is those times where you see the market just gaps out. It doesn't really come back down. So if there's any time I want to be in the market, it's that time. So that, well, I'll be in the market the shortest possible period of time and make the best amount of money. I don't like to stay in the market. So even if, let's say, I bought here and I don't use stop loss, and the market goes down, the high blood pressure to be giving you don't know whether it wants to keep going down or going up. What I want to see in the market is I get involved, the market either takes me out, hits my stop loss, or the market goes my way. So that I don't have my money sitting down and wasting time. Okay. So what happens is the market. So usually in this kind of instance here, as price made this high, this showed me this sign of strength. Most times I would like to see price come back down. Right? So I like to see price come back down. What I want to see that for is I want to see price come and they had to sell in heavily here. So those sell positions, I want to see them maybe come back down and close them or mitigate them. but it doesn't always have to happen. But this is the main important thing I want to see here. From here on, all I want to see is price begin to mark up. So at this particular instance, there was no trade here. There was no trade here. I only started getting involved in this particular market because as price made this move here, made a new high. So this is now a new structural shift. I wanted to see a move here. So I got involved here, and you can see how price moved away. Now, obviously, if you go into here too, you'll see some Wyckoff distribution schematics. So it's the same concept. The whole idea behind Wyckoff is weak to strong hand transfer. The composite man is taking your liquidity and trying to use it as fuel for their own price, for where they want price to go. So our idea behind understanding Wyckoff is so that we can wait for when he's ready to move and then join him. So follow who no road, essentially. So Wyckoff can be very interesting, but it's just one way of trading, right? Now, and you can't trade Wyckoff by itself. It has to be Is it the best strategy? No, there's no best strategy. It's something that you have to trade with context. Right? So you need to see. Now, sometimes the market it might just get to a point and just reverse. It's fine. So you have to have a way of trading. But this is just like Fibonacci. Somebody would say, oh, trade the 50% or the 61% Fibonacci retracements. It works, but it will not always work. So it's now left for you to break it down and figure out how you want to trade. What is if out of 20 trades, how many do I win? And then of the ones I win, what's the win rate? What's the risk to reward ratio? If I'm risking 1%, how many percent do I usually make? So once you have one of the most important aspects of trading is actually journaling. But most people don't like to do it. You want to journal. It's by journaling that you're able to figure out what works. It's not by trading because there are 1,001 strategies. Okay, so journaling is about taking notes of your trades. Many people open the charts and they see something and they take it. Oh, market is. And then they rejoice over the wins and then they cry over the losses. But journaling is about, okay, now at this point, I'm getting involved in this trade. As I'm taking the trade, I am recording my trade. I took this trade from here. Why I'm taking the trade, right? What is my expected return? So what's my stop loss? What is my target? So usually I take my trade based on RR, that's risk to reward. So I don't really target a particular area. If the risk to reward ratio doesn't make sense, I won't take the trade, even if everything aligns. So journaling is just about taking note of what you're doing. So now what will happen is if you take 100 trades and you journal them, after a while, you look at those trades, you will see where you're making mistakes. You'll see what setups works best. So you're like, oh, I took a trade based on counter trend line break, or I took a trade based on Wyckoff accumulation. It worked. This one works. At the end of the day, you say that, oh, the trades I took based on this time frame are working quite better. And then what you do is you now start to narrow down. Now, the goal is not to get to the point where you have a strategy that gives you 100% win, because it's not going to happen. The goal is to get to the point where you're comfortable with the system. And it's that confidence, when people take trade, most people, when they open a position, they cannot look away from the chart. It's always, they go back and because there's this, they're not confident about themselves in the trade. But how you should be able to trade like a machine. This is why robots tend to work, because it doesn't have emotion. It has a system, it believes in the system, and then it executes the trade every single time it occurs. So what you want to do is have criteria for trading. Okay, what do I look for? What do I look for to get involved? Now, when price is doing exactly what I'm looking for, how do I get involved? What is my risk to reward ratio? What is my risk percentage? And then once all of those things align, you execute the trade. Now, in life, we want to be optimistic, right? But in trading, you want to be a pessimist. That means every time you pull the trigger and open the trade, expect that you'll be wrong. That's the only way that you would actually make money in this market. Because if you expect to be right all the time, you think he would bother about risk? He won't bother about risk. If somebody tells you, oh, price is going up, and you know, if God whispers in your ear that gold is going up from where it is now, do you think you will be looking at maybe buying with 0.1 lots? You would load up the lots. Do you understand? Because even if it goes up 100 pips, if I use 20 lots, that was what that is. But usually that's how people approach it. They look at the market and they're like, oh, if I buy here, okay, it's going to go here. And they're looking at potential gains. Right? They don't bother about what if I'm wrong. And so when the market begins to go down, they're not ready for the loss. Like, they're not ready to take that loss and leave the market because they did not bargain for it. Imagine you have a $20,000 account and you trade 2 lots at once, and then the market is already going down and you're seeing minus 1,000 or 2,000. Am I willing to close this 1,000? So let me leave it maybe to go up. You know that feeling, and then you leave it. The market will now. Usually what happens? You buy. You want to take profits, right? And then the market goes down, and you're like, you're seeing minus 2,000. Then you're like, okay, to go up, and the market goes up again, and you're like, okay, it's going up. The market goes down again. And this is when you took your trade, The trade is now minus maybe 3,000. And like, this thing is good. Close this. Why not close? Before you enter the trade, you were not thinking about what you will lose. You were only thinking about what you will win.
But this depends on your stop loss.
Many people don't trade with stop loss. Or even if they do, they just move it around.
Oh.
Do you understand? Most people don't trade with stop loss. And this is for some of them, this is the reason why. When many people say, I took a trade, the market came down, took me out, or hit my stop loss, and then moved.
Oh no.
You understand? So like if we use this Wyckoff as explanation here, imagine people who bought here. Imagine somebody who bought here. They were right about direction. Not so. Because the market went up. They were buying in anticipation of price going up. But then price came down. Let's say price came down and hit their stop loss. And then what happened is the price now moved. If this happened to you 2 times, what will happen is people say, I'm not using stop loss again. Now here is where it gets bad. Well, they will buy, the market will go down. They are fine. The market gets here. No, because they're not using stop loss, they are fine. Then the market gets down even further. They are fine. And then as the market moves up, they are making profit and they're happy. Hey, this is all good and fine.
But as a stockbroker, what is your advice?
Always trade stop loss. Always, but it's your money now. Always trade with stop loss, right? Now, when this happens 1 or 2, 3 times, right? So you get involved in a position, no stop loss, and then it moves your way. Now, what will happen is this, right? Imagine this. Let's come back here now. Now, this is where it stopped. Think about this. You can see that there is also, you can call this another Wyckoff schematic here. Do you understand? Price came in, maybe these are preliminary supply, our selling climbers, automatic rally, our ST, our ST phase B, our sign up. So basically, you're seeing this whole thing here happen again. Now, the person gets involved buying here, right? So let me use this instead. So the person gets involved buying here, right? Maybe you're going after this, no stop loss. So stop loss is until the account is blown. Now, remember in that last example you worked.
Yes.
So price came down. Let's say if he had used stop loss, maybe it would have taken the person out here.
Yes.
Do you understand? Maybe you would have taken him out here or maybe here. Do you understand? But because he didn't use stop loss, what do you think is happening as price is going down?
No,
the loss is getting bigger. So all of a sudden, a loss that could have been $100 is now looking like $2,000. And then you start praying. You know, you go to church and you're praying that God, please let this thing just go up. Do you understand? So this is the reason why having, you know, you need to, which is why I talked about when trading, you want to be pessimistic. You want to expect the worst. We hope for the best too. Yes, but we expect the worst.
You need to put measures to guide you, because the most important thing is guiding that your capital.
Yes.
For future trades.
So they say, like I said, hope for the best but expect the worst. So expecting the worst is the reason why you want to trade with proper risk management. So you need to understand that losses are part of the game. Accept it. Right? But then what you want, this is the reason why journaling is important. Because then you will be able to see, you know, many times people, what all they remember is the profit or the loss they made. But when I trade, I don't really bother about the profit or loss I make. I remember why I traded in the first place.
Sorry, sir.
Yeah.
Is the leverage points applicable to this analysis?
No, it doesn't. Yeah, it doesn't. Right? So
I do want to understand that part as well.
Okay. So I'll come to it. Okay, so so basically, if you already have it predefined, oh, for every trade I take, I wouldn't risk more than 0.5% or 1% of my account. How many trades do you think you need to take before you blow the account? You need to lose 100 trades back to back if you're risking 1% per trade. If you lose 100 trades back to back, then your village trip is following you. Even if you're using the shittiest strategy. I don't know if you get what I'm saying. So by understanding and accepting risk, you protect yourself and you give yourself time to learn. Even if you don't know anything about the market, and I just teach you. So, you know, somebody just says, trade bullish pin bar. Anywhere you see bullish pin bar, buy. Anywhere you see bearish pin bar, sell. Only that. And then use risk reward. Let's say you're risking 1% on every trade to make 2%. Just that. Now, only that system alone can make you money if you stick to it. I don't know if you get what I'm saying.
Yes.
But where the problem would lie is where you now decide you're going to throw risk out of the window. And then, usually what happens is, this is the reason why I'm not a very big fan of signal giving. So you give, you give signal, and then the first, buy this at this point, sell at this point, stop loss, take profits. And the person buys, people on the group, they buy. It makes profits. The first one, first trade, good. Second trade, good. Maybe third trade, good or break even. Somebody took the first, second, and third trade. Now, at the fourth trade, next day you post another signal. Person, this is Mr. Obina, it seems he knows what he's doing. Person has maybe $1,000 or a $2,000 account, and decides this trade, based on the entry criteria to the take profit level, is 100 pips. If I make 100 pips, if I'm using 2 lots, that's $2,000. I'll double my account. And the person puts 2 lots on their $2,000 account. And that trade now becomes the one that is a loss. So all of a sudden, maybe you make, let's say you make 2% here, right? You make 2% here. Maybe you make 3% here. But then on this loss, you lose 90%. You see what the problem is? You in terms of win rates, you want 3 over 4 is good now. If you write the exam and you got 3 over 4, that's a good one. But 3 over 4 in this instance is blown account or loss of much of the fund.
That working with signals is not.
No, it's not signal I'm talking about. I'm talking about, it's not, the point is not signal. I'm just telling you why I don't like giving signal. But the point is, if you don't use proper risk management, you put yourself at risk, irrespective of the system you're using to trade. So most people are focused on how much money they want to make. And then when that's the focus, you're always thinking of, you're trading as though every trade will be a winner. But when you trade as though you're most likely going to lose this trade, you'll be looking at, if I'm wrong, how much am I losing? and you want to be comfortable with that loss. So like, okay, if I'm wrong and I lose 1%, I'm okay. You know that, oh, worst case scenario, I lose 1%. Do you understand? So that's the whole approach to trading. Right. So with regards to the strategy of today, which is Wyckoff, it's just basically weak to strong hand transfer. Usually happens in ranging market. So let me go back to gold or Euro USD. I think it's Euro USD. Okay, so remember, so this is Euro USD, and I said I'm waiting for opportunity to buy. I want to buy. I want to be a buyer in this market, but until I see the money coming. So this whole thing now we are seeing here might just be the start of a new Wyckoff schematic. Do you understand? If we see a bullish accumulation schematic here, I will be very, very interested in buying. I'm not buying because it's a bullish schematic, it's a Wyckoff accumulation schematic. I'm buying because the Wyckoff accumulation schematic is occurring at an area that I'm interested in buying from. Do you understand? So it's more like, this is what I want to do. I want to confirm. I want to see confirmation of that move. So let's say price, let me use part 2. So let's say price maybe begins to do something like this. Right? So let's say this is what price, within this area, price begins to range and then begins to, begins to present itself. And then I see something like this, right? Well, what will happen is as price pull back, I'll be looking for that confirmation to buy. I'll be targeting, obviously, now here's where it gets interesting. I'll be targeting this high. But remember that I'm looking at this from a higher time frame perspective. So I'll still be going after this overall high. And this is how we get into some ridiculous let me show you. There was a trade I took last. So I actually sent out this one on the Telegram channel. It was, I think it was this particular. No, it wasn't. It was from here, right? Don't mind these annotations here. I was back testing a system. Okay, so it was. Look at this same thing. This same thing that I'm looking for here is what happened here. So price is bullish from low to high, pull back. I'm looking for confirmation to buy. See what price did before going up. Right? I got involved in this trade somewhere around here. As price made this new high, you can see that this those of you online, I don't think you can see my hands. You can see that as price broke above the here, pull back down. So in this particular case, we're just coming back to close some of those open sell positions. And as price began to push up again, I got involved in a buy, eventually went after this high. And that's how we do the same thing over and over and over again. Okay. Now, this is, Wyckoff accumulation schematic is just one very important, one very interesting area of trading. Okay, so those of you online, I think I'll just take some of your questions. I don't know if I've missed any. So if you have questions, now would be a good time to ask them. Oh, someone say explain on the screen. It's quite difficult to explain on the screen because I have to use mouse. Okay, I hope you guys were able to follow nonetheless. Okay. Okay, so there is a, let me just quickly do this. So there is a clearer explanation with regards to Wyckoff in conjunction with market structure on ANZO course, so you can get access to that as well. Although you need to have a funded account. So we have some very interesting courses that you can access as a client of ANZO once you have your account funded. Okay, so I think that is here. So even if you're new to trading, you can see that, there is basically from the introduction section of trading, why you should use ANZO Capital. And then there's an advanced area, right? You can get access to this course. Just reach out to your account manager once you've funded your accounts, right? There's also this, so you can see, where is that? Where did I explain Wyckoff? Yeah. Yeah, so you can see understanding Wyckoff methodology. So there are two parts, part 1 and part 2. So if you break this into, break this down further, especially for those of you online, right? You won't be able to get all of this in one sitting, but this is more like, this would help you to get it even much better. And then once you funded your account and you're part of the team, you'll also be able to join me on my live classes that I do have weekly. Okay. And then there's also the one that I'm currently working on, which is on how to build Forex robots. Okay, so you can also, very detailed class on this as well. So all of this you can get access to easily once you have funded your account. Okay. Most of our classes are online. Most of the classes are online. See the difference between physical and online. And which is quite better sometimes, I think. But would have like this now, would have some classes like bi-weekly, bi-monthly, sorry, so twice a month. But to really get in depth with many of the things, you have to join in classes online, like the courses or live classes online. I think that's the best and the fastest way, because then I'll explain a specific thing, Okay, questions. So someone says you joined this, so don't worry, the class is recorded, it will be uploaded, and then you'll be able to get the link. So just reach out to your account manager, let's say maybe by the end of today, or let's just say maybe by the end of today, the class should be live online. Okay. I hope you guys enjoy the class. Those of you online, I know it's not exactly very easy, but I hope you're able to grab something. Okay, I hope you enjoy the class.
No, I did not enjoy it because I don't understand I'm just asking the layman.
No, it's necessary. The point is, one of the key points here is, I don't expect you to grasp everything, except you already know to a certain extent. Right? I don't expect you to grab every single thing at once, but you get it eventually, right? Like the course would help you, and it also help you.
So I want to be sorry.
Yeah.
I'm not taking you back.
No, it's fine.
I need to understand. ANZO Capita.
Yeah.
What do they really trade on apart from FX? What other products do you have access to?
Okay. Okay, so ANZO Capita, we're a broker, right? We are a broker, and with us you can trade FX, obviously, but you can also trade commodities like gold, like crude oil, and then you can trade indices like US 30, DAX 100, and all the NASDAQ. You can also trade crypto. So you're trading. Remember, you're trading the prices. The fluctuation in prices. You're not actually buying and
holding them. So apart from MT4, you can also use MT5. You can use MT5.
Yes, you can use MT5.
So apart from this, what you're doing online,
yeah,
you have because practical teachings, one-on-one, like you're showing people, you have classes where you put people through from the scratch how to come on board, how to do your registration by themselves on their platforms. How to fund?
Yeah.
Do you understand how to connect for MT4 and all that?
Yes, we do. That was actually, that's actually one of the things I just showed you on this class. It's
I was not looking.
No, just now. So you'd see that this is, and it's a video class. So each section has, so you can see this is introduction to the financial markets, right? This is why ANZO, so about ANZO Capita, the questions you need to, how to create an account, right? You can see, right? The MT4, getting familiar with the MT4, using the MT4, using the MT5, so how to place trades, so all the basics. So if you're new, there's a place to start. Like you would get, by the time you're done with this, you should have a concrete understanding about.
If I'm doing this on my own,
yeah.
Do I need trust score FS? I don't think so.
But here's the thing: there's something with experience. Now you're not going to go from, even if I sit you down, even if I sit you down and I teach you everything I know, you can throw out today. You cannot be like me, because everything I know did not come from one learning. It came from experience. So everything I know being done over 9 years. I've been trading for like 9 years. So that experience, you can't buy it. You have to experience it. That means you experience all the profits and all the losses. So it's very important that you start. Now here's the thing, they say the best time to plant a tree was 20 years ago. The next best time is now. Because if you don't plant it, another 20 years will pass and you will not still. So it's good that if you're maybe taking advantage of a system, you're learning. So that maybe at some point you don't need the system again. So you don't share profits if you don't want that. It's all up to you. Yeah. But you get to the point where you're on your own, you're comfortable. So you can not risk, because if you don't risk all your funds, you can maybe try and make money now using another system. And then when you're confident enough, you can then do it yourself. So yeah. Okay. So somebody says, what would be, oh, thank you very much, Daniel. Great class. What would be your advice to, what would be your advice for this strategy as a scalper? Now, as a scalper, yeah, you can also apply this as a scalper, but it's also,
what does it mean by scalper?
So scalpers are people who look to get involved. They like to get in and out of the market very fast. So they use they're feeling like 1 minute time frame, 30 seconds time frame. So
they jump in and jump out.
Yes. So you still see Wyckoff schematics, accumulation and distribution schematics on the 1 minute time frame, but it will not be as, you see a lot of it. That's what happens with lower time frame. You see a lot of it. It's just like even something like pin bar or trend line break on the 1 minute time frame, you see lots of pin bars as opposed to a 4-hour time frame, as opposed to a 1 day, a daily chart. So you can apply it, but what I would advise would be, you want to maybe make sure that you're looking at an area, because on a 1 minute time frame, it looks like a lot has happened. But if you just zoom out, you see that it's just 1 hour. Do you understand? So you want to make sure that you're looking for those confirmation within an area that you're interested in getting involved from. So let's say you're looking at the 1 hour charts, I use 1 minute charts to myself. But I don't specifically go to the 1 minute time frame to look for trade. Let's say, okay, so let me give you an example of something I might do. Okay. So now let's assume, right? Let's assume that this price now has done everything I want to see. And now I want to buy, right? Now this is the 4-hour charts. I don't get entries on, I don't like to enter the trades on this high time frame. What I might do is, now remember, I already have an idea of what I'm looking for. I want to buy. Do you understand? So even if I'm going down to a smaller time frame, I'm still looking for buy opportunity. So now let's say I drop down to a 5-minute chart, okay? Right? And now I'm looking at this 5-minute chart. Now, if you look at this 5-minute chart, it's an entirely different world, right? You're seeing it's going up, it's coming down, it's going up, So I want to, now, I'm only going to be focusing on confirmations to buy. Do you understand? So if I see a confirmation to buy right now at this particular instant, now, so let me look at this, right? You'd see this price made this low here, broke above this high, made a new high, made a new low, right? So right now we've made a high, a low to high, a lower low, sorry, a higher low to a new higher high. So right now, just looking at this on its own, if I'm looking to buy this, I don't expect price to come below here. Do you understand? If this price really wants to go up, the way I think about it is, well, if this price wants to go up, then price should not be coming down below here. So let me use this. So price should not be coming down below here. Now, remember, I'll be looking at this already as price is coming down here, right? Now, this is the 5-minute chart. Now, if I go to the 1-minute chart, for instance, as price is approaching this area, what am I looking for? I'm looking for confirmation to buy, right? Now, all through this area, you can see how price is just going down, right? So price just going down. It pushed up here. So let's say at this point here, as price made this high here, I'll probably be interested in looking for buy opportunity, right? Now, I'll probably be interested in doing something like this. Get involved in a buy somewhere like here. Put my stop loss below here. You can see that. And then I'll probably be going after overall highs. Now, I'll take partial along the way nonetheless, right? So remember that I said, if price really wants to go up, then I don't want to see price come down below here, right? So you can see that I'm factoring in the higher time frame to the lower time frame, even though I'm getting entries on the lower time frame. And then if you're looking for Wyckoff here, you can probably still see something like that. Now, I don't see any clear Wyckoff here. I don't see any clear Wyckoff in this particular instance here, but this is how you can wait for accumulation schematic like this, and also look to trade that here. So this would be also a valid one. So you can apply this in any time frame. It doesn't matter whether you're trading the weekly time frame or you're trading the monthly time frame or the 1-minute chart, you still see the same thing. As a matter of fact, you can still see some sort of stopping action. So our preliminary supply, our selling climax, automatic rally, our secondary tests, our ST, our sign of strength in phase B, our spring. As a matter of fact, this might be now remember, this is within a structure. So even though we're looking at a 4-hour chart, in a 4-hour chart, it has no setup. But in a 1-minute chart, it's appearing to set up. So if price, let's say, looking at this now, right? If price comes back down here, if price come back here, then I'll be looking, then I might be looking to buy if I was focused on buying. So if price come back down here, then I'll look to buy. And I'm confirming this because of this. I'm confirming this with this sign of strength here, and anticipating that price comes down here, mitigates, and then continues to push up. So you can apply it. You can apply it everywhere, but you need to factor in where you are in the overall scheme of things. That's with the higher time frame, and then use the lower time frame for confirmation. Okay. The reason some people would like to scalp is because they have time to do so. Other people, well, you don't have the time to be looking at 1-minute chart. So you want to maybe get involved on a slightly higher time frame, 5 minutes, 15 minutes, 1 hour, all of those things. So you get better at this. It's just like with everything. Before you started driving, it will look like, and then you start driving, and the next thing you don't even think about it. It's so it's
just continue.
Yeah. Okay, any other question? I hope you guys enjoyed the class so far. Yeah. Okay, let's see, somebody says there is the part where you explained that got me interested. That's why I asked. The question is, okay, thanks. Okay. Now, what's your ratio on CP and SL? Now, that one is also down to the individual, right? Okay, so on calculation, now, this one is actually quite simple. Now, let's assume this trade. Now, let's take this trade, for instance, and let's say I want to take this trade, right? Now, already, I have an idea as to why I want to take this trade and what I'm expecting. So I don't expect price to come down below here. This is the line I'm drawing here. So I don't expect price to come down below this area, right? That means my stop loss should be maybe 1 or 2 pips below it, just for spread case, right? Now, does that mean that this means that if I buy here, my stop loss will be here? My first target should be at least this high. Now, risk to reward ratio. So let me use this. In terms of risk to reward, imagine if I bought here and I'm targeting this high and I'm going after, my risk is this low. You can see that this risk to reward ratio does not make sense. I'm risking, I'm risking 1% to try and make 0.7. Now, there's a good chance the trade goes my way, but it doesn't make sense in the sense that if I keep this up, I'll be losing at the end of the day. Like after 10 trades, even if I win 5 and I lose 5, I'll be on net negative. Do you understand? So I like to personally, I only when I look to trade, the minimum I go after is 1:3, 1:4. But I also have my own rules for partially out. So for instance, I'll be interested in taking a trade in this trade if price maybe comes down here. So let's say this red area that I highlight, this gray area that I highlighted here, like so. And let's say let's just imagine I use a pending buy, right? So pending buy limits, and I just walk away my stop loss like so. I might take profit like so. Notice that I'm still going after the same high, right? I'm still going after the same high. But my risk is now like this. This is what my risk is. Now, what is the disadvantage of this? Well, the disadvantage is that price may not come down here. It may just go up, in which case I don't take a trade, right? But if it comes down here and it gives me an entry, I'll make more. Now, it doesn't have anything to do with with how much pips. I can make more in this particular trade than somebody will make in a 100 pips move. This whole move here is just about 29 pips. But because I'm focusing on my risk to reward ratio, so that means, let's say I'm using a 10K account. On this trade, I only risk $100. That means I'll calculate how many pips is this? My risk is 5 pips. Or let's just call it plus spread, 8 pips, right? Now, if I'm risking 8 pips, what lot size do I need to use such that if I'm wrong and it hits my stop loss, right, the loss does not exceed $100, which is 1% of my account. If I use one lot size, if I lose 8 pips, that will be 80 lots, which is within range, and maybe I'm fine with one lot. Do you understand? So now I'm risking an exact percentage. So that's how you calculate it for the person who asked that question online. So you look at, okay, where am I entering, and what is where do I get out? Where does my stop loss lie, and how much is at risk in pips? And then you decide what lot size you need to use to get that exact value. Okay, so say for $1,000 accounts, that's the disadvantage, which happens occasionally when scalping is what I asked. Okay, I hope I've answered your question. But it doesn't matter what account size you're using. Especially once you're $1,000 and above, there's always it's only when you're using very, very small accounts that you're very limited. But like $1,000, you can use, at least on $1,000 account, 1% is $10. That means you're risking $10 on every trade, which is fair. So you can always use, even if it's 0.01 or 0.02, and then if you and then if you make the wins, so which will be in this case, if you risk 0.01, if you risk $10 and you make 5%, right? That will be, so you $50 on the account. Now, obviously, personally, I have my own rules for partially out. So let's say I'm looking to take this trade at 1:2, right? When price, let's say price gives me an entry and it's moving my way, right? Now, when price gets to 1:2, that means I'm now 2% up. I would usually take partial. I'll close part of my trade, move my stop loss to break even, and let the rest run. So I've secured 1%, and then it either comes down and hits my stop loss, which is now at break even. That means I don't lose anything, or it goes my way and I make the extra. Okay. Okay, so says you use 10% and 30%. Well, if it works for you, there's no, I'm not telling you what to do. That's the good thing is you have to figure out what works for you, what you're comfortable with, because people are different. There's some people who are okay, they like risk. You've not met people like that. They are very okay with risk. They can risk anything. They might be willing to risk 10% of their account on every trade, but you're only willing to risk 0.5%. As long as you are okay with the risk,
conservative.
As long as you're okay with the risk, that's fine. Okay. Okay. Yeah. That's about it for our session today. Thank you everybody for joining in. I hope you had a good time in the class, and the recording will be made available. Yes.